All right. So thank you again for everybody who wants to participate in the meeting today. We're talking about insurance coverage. There's so many ins and outs related to HOA insurance with all the deductibles and changes in the industry. We thought this would be a great topic to bring to our board members. A few of you did submit questions in advance of today, which is super. We're excited to answer those questions for you. If you do have any questions that pop up during the session, use your chat feature and we will make sure and get to those questions so that we can get all those answered for you. So with that, let's get started. So things we're going to be talking about today: how we make sure your association has proper coverage, where we look for that information. How does the renewal process work? We're going to talk about wind hail deductibles and per occurrence deductibles, and then we're also going to talk about HO6 coverage. Our speakers today are Cheryl Phillip with Omega Property Management and Tony Ciro with American Family. So I'm going to introduce Cheryl Phillip with our team. She's been in the HOA industry for 18 years. So she has seen a lot of things going on with the insurance world. She is our insurance coordinator, so she will be your point of contact for setting up your renewals. A little fun fact about Cheryl is that she lives in the Black Hills and has a whole menagerie of creatures living there with her: dogs, chickens, horses, cattle, and a cat named Tommy. So with that, I will turn it over to Cheryl.
Hello, everyone. How are you today?
We're great.
Great. Well, so when we start with the insurance, what we look at first is the association's governing document, and that is the main thing that we start with is the declarations. We're also going to talk about communities under development and how we handle those, and then insurance onboarding. So the first, we're going to be looking at a few different samples of the various governing documents of the associations, the declaration samples. So this particular one is an example of what each homeowner is supposed to carry. So it's outlining the HO6 requirement. And when you're looking down at the description down towards the middle there, it's saying that each owner is responsible for ensuring these items, and it's the ceiling and wall finishing materials, floor covering, cabinetries, finished millwork, electrical, heating, ventilating, etc. So that is what we call bare walls coverage. The association is not providing the coverage for those items. That is what the unit owners have to ensure on their HO6 policies. So bare walls coverage differs from studs out. That was one of the questions that we received. Studs out means that the association is going to cover the studs and then everything to the outside of the building. So it's different in that the association in the studs out does not cover the sheetrock. With bare walls coverage, it does cover the sheetrock, and it's not going to cover the wall finishing materials like the painting. So you can go to the next one. This example is an example of what the association's insurance requirements are. And again, it is excluding the ceiling, wall, flooring and things like that. So that's bare walls again. And then it's further down into the language, it's talking about some of the endorsements or coverages that are required. In this one, it's saying a special condominium endorsement. That's pretty much provided by any association insurance company. Inflation guard endorsement gives the association a certain percentage that is going to increase the values every year. It helps to make sure that you're not undervalued. It's talking about the construction code provision that requires change to undamaged portions of the building, that's law and ordinance coverage. And we have that on most of our association policies as well. Then it's talking about some of the other things like mechanical breakdown coverage if there's central heating and cooling. It's going into the liability coverages. And the big thing that we look at here too is the insurance shall be in the amount of not less than full insurable replacement cost. So these are the things that we're looking at each time we are looking at insurance for the association. We make sure that the policy is matching what we have in the declarations. So in the next one, this one is not talking about any units or interiors. So this is going to be what you'd see with a single family association or a master association. So it's talking about the liability for the common areas, and then it's talking about if there are any, well, this one I guess doesn't talk about any property at all, but if there are things that the association is supposed to maintain, like fences and mailboxes and things too, those would be covered into the declarations. The next one, this one is talking about fidelity or crime coverage. So our associations usually have coverage on the property if it's appropriate, if the units are covered by the association, the general liability under the package policy. Then we have fidelity or crime coverage that covers the association for any theft, miscellaneous disappearance, whether it's from the board, the management company, volunteers. And that is typically required by the governing documents, not all the time, but in this case, it's showing what the coverages should be for that. And in this case, if you look at the bottom of that first paragraph, it's telling you what the limit should be. In this case, the association's policy should cover the maximum funds that would be in the custody of the association or the managing agent. So the required limit that we look at then would be the balance of the operating and reserves. And typically we do that at the renewal to make sure that the coverage is adequate, or we don't need to bump it up. Now, the next slide is just an example of miscellaneous policy provisions. And these all look like they're for the property policy. So we also look at those. Normally, those are already included in a lot of the different coverages, so we don't have to do a lot of changes to that. The next one is a single family community. And it says master policy of insurance in accordance with the requirement. So it's going to cover the liability, and it's going to cover if there are any common elements like a clubhouse, fencing, mailboxes, monuments. All of those are going to be covered by the master association policy as well. The next one is also for a single family community, and that's just outlining the liability requirements. And we always quote at least $1 million. We don't have any insurance company that we're quoting less than $1 million on, and some of them we carry 2 million on, and umbrellas. We would also have umbrellas as well. With the next one, that is also another one that's talking about the crime or fidelity coverage. And on this one, at the bottom, it's telling you what should be the amount on the policy, and it's talking about the greater of the estimated maximum association funds, or a sum equal to 3 months aggregate assessment. So the monthly assessments from all the homeowners, 3 months of those, plus reserves. So when you sometimes get a request with a financing of a homeowner's mortgage, sometimes a board may see a request come through from me that's asking for higher crime limits. And that is typically always because it's an FHA, a VA, or a HUD loan, and they're following those requirements of a sum equal to 3 months of the aggregate assessments plus reserves. So that's what they want to see. So sometimes if you see that coming up as a board member, that's why. Now, the next one, those are some of the other insurance requirements that we see. And we didn't have an example of the D&O coverage requirement on the declarations. So sometimes that will also be a requirement. The directors and officers coverage, D&O coverage, is what protects the board of directors from lawsuits. And it's based on the decisions and the policies from the board of directors. So the general liability covers things that are related to the property, a gap in a sidewalk or a dead tree that needs to be trimmed down. And the D&O just specifically, like I said, protects the board from the lawsuits regarding their decisions and their policies. One thing that we're asked about a lot is workers' compensation. And it says here, workers' compensation insurance as required by law. Well, since most associations don't have employees, it's not required by law, but there is a loophole in the state statutes that says that if an association hires a contractor who fails to provide work comp coverage for their employees, and one of their employees gets hurt while doing work for the association, then the association becomes, the quote unquote employer. So if a roofer is doing some work at the association and they let their work comp coverage lapse and somebody's hurt, then the association would be expected to have the work comp coverage. Now, contractors can provide us with a certificate of insurance at the beginning of the year, say their policy is effective in January, and if they don't pay it in February and March and it cancels, they could still submit the certificate to us showing that they had coverage for the year, but we wouldn't know that that had lapsed. So the great majority of our associations buy the work comp policy to safeguard against that situation. And we typically use it's called the PMA, Pennsylvania Mutual. It's a combination work comp and volunteer policy. And those are typically, depending on the limits that you get, anywhere between like $487 and $566 a year. So it's not a really expensive coverage either.
Cheryl, do you want to touch on the PMA policy as it pertains to volunteers?
Yes, so the PMA policy is a really good policy for the volunteers because it acts the same as a work comp policy does. There are other volunteer policies on the market and they are not nearly as comprehensive as the PMA. So with the PMA, you're getting the same coverage as the work comp. So you're getting the medical coverage, you're getting the loss of wages, and you're getting the rehabilitation services. So, say if you have a volunteer that is doing landscaping, refreshing the mulch around a monument or something like that, and they throw out their back, then they have the coverage. And that's kind of handy, especially with the larger deductible medical policies that a lot of people have. So this will kind of fill in that gap so they aren't paying anything out of pocket. And I've even heard of it wasn't one that we managed, but there was I heard from an agent that they had a claim on the PMA policy. During an annual meeting, the volunteers were putting out glasses on the table, and one of the glasses shattered in the person's hand and did something to it. I don't remember exactly what the specifics were, but yeah, so then they had that medical bills and some rehabilitation services that were covered by the PMA policy.
Great, thank you. All right, so I am actually going to jump in here and talk about communities under development. So one of my roles with Omega is to work with all of our developer communities, which could be for communities that are, just getting started. They're basically dirt with a few roads in it to the point where they transition to homeowner control. So a couple differences with how we manage the communities under development is, first we have to identify what the final build plan is with the developer. Of course, things change as a plan progresses, but we need an initial review of what common elements there's going to be, what are the building going to look like, especially in like a townhome community. What finishes are they going to have? What type of shingles are they putting on? We need to look at all of those components. And then what we will do is provide install pricings from the developer to the insurance carrier so that they can give an estimation on what that will look like for their premium when we're looking at, once those components are completed, what does that look like as a cost to the association? And then as homes close, what's very important for our team to do in conjunction with working with the insurer is providing them all of those home closing dates. At that time that the CO is authorized, the developer will no longer insure that home. So we need to make sure that the HOA is covering that home. So American Family is one of the vendors that we work with, and Tony and Josh are on the call here. So they have a lot of experience working with getting those new communities set up. So that's just a little FYI on what we do with communities under development. Now I will turn it over to Cheryl.
All right, so our onboarding is what we call it when we get a new association in. So the onboarding process, we either provide it at the first board meeting when you're first with Omega, or we do it at the first renewal, depending on what the board requests or what the timelines we can meet. And what we do with the onboarding process is we first take a look at the governing document and make sure that the requirements in the governing documents are being met by the current policy. And then we make sure with the current policy that it has the proper coverage, that there aren't any exclusions where we don't need any, and to make sure we take a look at the reserve schedule to make sure all the auxiliary structures are covered. And then say if they don't have workers' comp, that would be something that we may recommend that they take a look at least. And then we'll put recommendations and premiums for the board to consider on everything that we're recommending. All right, so I get this a lot with the boards. There are management companies out there that automatically get 3 bids at the renewal, and we do not do that for several reasons, but the main one is that there is a benefit to staying with a company, the same company, for a while. If you're hopping from insurance company to insurance company, if you have a loss, an insurance company, especially in this market, they're going to be much more likely to non-renew you than if you've been with them for a while. So if there are large increases, if you're not happy with the current deductibles that are on the policy or certain exclusions, the board can always request to have it bid out, and we're happy to do that. But we don't automatically do that just for the heck of it if the board's not even interested in entertaining a quote. So the renewal process is basically that I request, we have an Omega spreadsheet, and I request that from the agent, and we get them typically between 21 and 30 days. It depends on the company. Some of them get them sooner, some of them are right at that wire. I send those to the board with a summary of the increases. If they have any coverage questions, I go over that with them. I do sometimes attend Zoom calls to discuss options. If it does go out to bid, there is the same spreadsheet that I used for the renewal is also provided with other columns for the various companies. So that is something that I can do if you do want to have quotes. Sometimes it gets a little bit challenging when we're getting the renewals, so close to the renewal date, like at the 21-day mark. Most agents, they need 30 to 45 days to be able to work up an association quote because there's a process to it. And we run into that when we get them so close to the renewal and they do want to go out to bid. What we can do is renew with the current agent and then get the quotes, and then you could always change renewal dates. So that is always an option as well. We bind the coverage prior to the renewal date, usually right after the board makes a decision. I'm contacting the agent to let them know. And then we get this, when I let them know about binding the coverage, then I request the certificate of insurance and the HO6 letter. And those are sent out by the agent to every homeowner. I usually provide them with a homeowner list to get those mailed out. If there is a change in carriers, then I would be putting together a cover letter outlining the change in companies, the change in deductibles, whatever those are. And then we would send that from Omega. And I just want to address a couple of the questions there, because there were a couple of things that we didn't really talk about. So one of the questions was the difference in the terms between all-in, bare walls, and studs out. So we talked about studs out and bare walls. All-in is the most common, I think, of our coverages in the declarations. All-in means that the association is covering everything that is physically and permanently attached to the building on the inside and out. So that means that the association is going to cover the floor coverings, the cabinetry, the millwork, the fixtures, built-in appliances. All of those are going to be covered on the inside. So the HO6 is just basically covering the deductible and the loss assessment coverage. And then another question was why? Well, actually, that's the only one that I'll answer right now. And then we can talk about the other ones at the end, because there may be some additional ones similar to the ones that we have here already.
Thanks, Cheryl. All right. Thank you so much for that. I am going to, we got one more person popping in. I'm going to turn it over to Tony Ciro with American Family. Just a little background on Tony. He is licensed in 15 states. That is correct, 15. He's been working with HOA insurance since 2006. And some fun facts about Tony and his company. They are insuring over 300 associations. His whole family is in the insurance business, which is kind of fun. And then he does attend a lot of industry meetings and town halls and board meetings to talk about coverage. So just a plug for your insurance agent, all of you board members. Many of them will attend your annual meetings to talk about coverage. So if you have questions about that, talk to your manager and they can help facilitate that. So with that, I will turn it over to Tony.
Yeah, so we have really boring family dinners, talk about insurance a lot. Yeah, so thanks for having me. Some of the questions we get a lot that Nicole wanted to address was, how do deductibles work? How are they calculated? What's the difference between a per occurrence deductible and what we call a wind hail deductible? And then we'll walk through a couple scenarios. How would that deductible apply? If we had a plumbing leak, how would it apply to an actual hailstorm? And then talk a bit about this idea or concept of assessing deductibles to the unit owners. So next slide. So I'm going to use a kind of hypothetical association to answer a lot of these questions and help you guys understand. So every year you should be getting something from your association manager, which comes from the insurance agent, indicating how is your association set up for coverage. So Cheryl just did a great job of talking about how you look at the governing documents to determine how it's set up. But you as a homeowner need to understand that as well and be able to give that off to your personal agent so that they can fill that gap. So for example here, if betterments or improvements made within your unit are not covered, you want to pick up that coverage on your unit owner policy. But we've mainly put this in here to look at the deductible. So in this particular association, they've got a $20,000 deductible per occurrence. And that is going to apply to any claim that is not wind or hail related. So that could be a water claim, that could be a fire, that could be vandalism, that could be a vehicle that runs into the building, so on and so forth. And with a per occurrence deductible, it doesn't matter how many of the buildings in your community are damaged or how many units are damaged. You're going to pay one deductible of $20,000 for that event. Now that is different from a wind or hail deductible. And wind and hail deductibles really came into the marketplace, I'd say 4 to 5 years ago, as companies have battled with profitability, as companies have paid out more in claims than they've taken in premium dollars. This was a way for them to alleviate some of their burden and pass it on to the homeowners, who ultimately pass it on to their what we call HO6 policies or unit owner policies. So how does a wind and hail deductible work? Well, within your complex, and I'm going to make up a complex here, right? So I decided we've got a complex with 10 buildings, and every building is has 4 units, and every building is about $1 million in coverage. So $1 million times 10 buildings, we've got a $10 million complex, and the deductible would be 5% of that. So 5% of 10 million is 500,000. And so that wind and hail deductible after a storm would be $500,000. And we will talk about in a second, how does that get paid? One really important thing to note is that you could never have a situation where you would pay a wind and hail deductible and the per occurrence deductible. It's either or. Okay, next slide. So let's talk a little bit about how do these deductibles work in the event of an actual claim. So one of the claims we looked at was a plumbing leak. One of the units has a plumbing leak, causes water damage in their unit. In that case, the per occurrence deductible would be applied to the claim. So if there was $50,000 in damage, the insurance company would pay $50,000 minus the $20,000 per occurrence deductible. The insurance company for the association would pay $30,000. If it was confined to one unit, then that one unit would be responsible to pay that deductible. They would have their HO6 policy essentially pay the first $20,000. The master policy would pay everything over and above that. Let's say that there is multiple units that are, let's say there's 2 units that all have some damage from this water event. At that point, there's still a $20,000 deductible total. And it would be up to the board to decide, are we going to give all $20,000 to the unit where it originated? Are we going to give $10,000 to each unit? But there'd be some decisions there as to how that deductible gets divvied up amongst the affected units. With a wind and hail claim, again, we said in this hypothetical association, we'd have a $500,000 deductible. Then that's if all the buildings are damaged, right? Question is often, well, what if only some of the buildings are damaged? Or what if only one of the building is damaged? Well, within the policy, every building has its own coverage limit. So in our example here, we had 10 buildings, each valued at $1 million. And so if only one building is damaged, then we take the 1 million times 5%. So that's 50,000. Of course, all 10 are damaged. You'd have 50,000 per building. Total is 500,000. Let's go to the next slide here. Oftentimes, the next question around the wind hail deductible is, wow, a $500,000 deductible. We don't have that in our funds to pay that. How is that going to get paid? And so within your governing documents, again, the same governing documents Cheryl was talking about, there should be language in there that speaks to what your parameters are for assessing a deductible. And most of the language is very standard. Certainly you can pay the deductible as a common expense, right? That may be feasible on the $20,000 per occurrence deductible. Probably not feasible on a $500,000 deductible. But it also says you could assess the deductible amount to the units or units affected in any reasonable manner. So in our example here, I was, thinking there's 40 units. Well, that means we could choose to assess 40 units, $12,500. That would make up the $500,000 deductible. And that's almost always the way that this is done with a wind hail deductible, is you divide it out over the affected units and you assess it out. How does that get handled when the homeowner gets that assessment? They would turn that assessment notice in to their personal policy called their HO6. And their HO6 should have coverage, if set up right, to pay a loss assessment claim. And then the last way that a deductible can be assessed out is to require them to, the unit affected, to pay it directly. So in that plumbing leak example, we said, we'd ask the homeowner with damage to turn it in to their personal policy. They'd pay the first $20,000, and then the master policy would pay the remainder. That's asking them to pay it directly. So those are your three most common methods, and they work very well in no matter the situation. But that's the guidance that you would look to for assessing it out. And we'll go to the next slide. So we're going to go through some your HO6, again, that's your personal policy or your unit owner's policy. But we get some common questions there, and Nicole's asked me to answer some of those. So how do you know if your neighbor has an HO6 policy, right? And again, people are worried about this because, without an HO6, they could be on the hook to pay, in our example, that $20,000 per occurrence deductible to have a plumbing leak, or they could be responsible to come up with $12,500 if the deductible gets assessed for a wind hail claim. How do I know if my neighbor has it? And the reality is you don't. We have no real means for knowing if our neighbor has coverage or not. Certainly you could ask them. But in general, there's no requirement telling them they have to have an HO6. Now, if they have a mortgage, the bank will require it, but if they don't, technically they could self-insure. So we have no real way of knowing if our neighbor does, other than to, be friendly and ask them. How do I know what to include in my HO6? When I started talking, that little snippet of a letter that said, how your governing documents read, what your responsibility is, whether it's, to cover from the walls in, or whether it's just improvements and betterments, or, if you have an all-in policy, you're just responsible for the deductibles. But, that coverage letter that comes out is really important to look at. It's really important to hand it off to your personal agent. That's going to tell you what kind of coverage you need. It's going to tell you what the per occurrence deductible is. It's going to tell you what the wind and hail deductible is. And those are the three main things that you need to be protecting yourselves against. Next. What if I don't have insurance? Or what if I don't know if I have enough insurance? We would recommend that you call your personal agent. Call an agent you work with. Maybe it's the agent that insures your vehicles. If you don't know an agent, or you use an online company, ask your property manager. They probably have a lot of resources to refer you to an agent. Maybe it's the agent that insures your community. They certainly have knowledge of how your association is set up and what gaps you need to plug, but you do definitely want to find a trusted agent to help you. Where do you find the information? Again, that annual coverage letter that comes out, oftentimes those are mailed. They may come in an email. They're in your annual meeting minutes or documents. They might be on your community site through Omega. Give me the rest of the bullet points there, Nicole. Did I get them all? Yeah, your annual report, the annual mailer. It might be in Caliber. Or ask your property manager as they can help you. So. And then I know there was a couple other questions that came in, and if anybody else has some for Cheryl or I, feel free to put them in the chat here. But I've got two that came up that I'll go ahead and answer now. Both of them are related to pricing, cost increases in the industry. One of them is, are the rates for our association going to go up? Are rates going up in Minnesota? What should we expect in the future? Minnesota has been a really, really difficult market. Certainly in the 15 years I've been doing this, every year without exception, we have hail come through the metro area. Some years the storms are worse. Some years we have multiple storms. Some years they're better. But this has really led to a big problem for companies. Companies have had to deal with the fact that, you know, in most years, for every dollar they take in, they're paying out, you know, $1.30 to $1.50 in claims. When you think about your personal budget, you know, you can't operate very long without making some adjustments. In the last couple of years here, this 2020 was a very bad storm year. And we're starting to see a lot of those claims finalize and pay in 2021. And, you know, again, companies are in a position industry-wide where they've paid out more than they've taken in. And so how have companies dealt with that? One, there's companies that have said, we just don't want to do this anymore. We're not going to continue to insure associations. We're going to non-renew the accounts that we work with. Or we're going to non-renew accounts that have had claims, like Cheryl said earlier. Two, they've had to raise rates, right? Just like if you're, you know, have problems, your more expenses are higher than your budget. One option is to bring in, you know, more money, and so they've chosen to raise rates, and that's been going on most of 2021. And I see that persisting into 2022. What that exact percentage will be is dependent on a lot of factors. It's dependent on your individual claim history. It's dependent on your, you know, overall maintenance, your community, the condition it's in. But I would say that's probably in the 15 to 20% range, maybe less, maybe more, depending on. So I do see that continuing. And the other way that companies have addressed this profit problem is with the wind and hail deductible. You know, as we walk through this example with a 5%, you know, that's becoming more and more commonplace, to have a deductible of that structure. And that's so that some of that risk can be passed to the HO6 through the assessment. And then the other question was, what percentage has HOA insurance increased over the past few years? You know, again, that can vary from community to community, but I'd say it's probably been in the neighborhood of 10%, you know, year after year. One of the other things to remember is that the coverage amounts have been going up as building materials have increased, as it costs more to reconstruct. You know, the governing documents say that we have to continue to insure your complex at 100% of replacement cost, as Cheryl indicated earlier. That means the coverages have to go up. When the coverages go up, it brings with it a cost increase. So that's part of it too. But I'd say about 10% year to year has been probably pretty average.
All right, looks like we have a question. Oh, yes, Edna, we will definitely be able to share that.
And I would like to address a couple of questions and dovetail into what Tony was just saying. The question was, are we able to get competitive quotes and comprehensive coverage? Now, given the current association market in Minnesota, insuring associations for the exact things that Tony was talking about, it's getting tougher. There are carriers leaving the market. Those that are staying in the market are increasing their wind hail deductibles. Some are starting to put endorsements on excluding cosmetic damage, non-matching of siding or roofing, you know, so we are seeing tweaks in coverage to help the insurance companies remain profitable in the state. So the pool is getting smaller, the underwriting guidelines are getting tougher, and it is going to be more of a challenge to get competitive quotes and, you know, comprehensive coverage. Another Another question was, why do insurance companies put restrictions on grilling when there are far more risk associated with other items like fireplaces, microwaves, stoves, space heaters, to name a few that have no restrictions? And for that, each insurance company has their own guidelines as far as what their restrictions are for their underwriting process. Grills are a hot button just because, and it's all based on statistics. They look at the actuarial information when they're looking at what to exclude or have restrictions on. And grilling is a big one because it could impact so many people. Like if you had something with your microwave, it's going to be restricted to one unit. If a grill starts the building on fire, it's likely going to be the whole building that's going to be impacted. So it's just based on the underwriters and the statistics that they're looking at when they have those restrictions. So there are a few companies that will not allow grilling on decks. There are other ones that say that there's a minimum of 10 feet. Some go a little bit further than that. But that's why, and each company is different, like I said.
Yeah,
And then
Cheryl, I'm going to piggyback on you on that one.
Sure.
I think one of the reasons grills get brought to the forefront is when insurance companies go out to inspect a property, they typically are doing exterior inspections. And so while whoever asked the question might be right that, smoking could cause just as many problems, the inspectors can only see what's on the outside. They don't know who smokes. They don't know who's got a fireplace, who, et cetera, but they can see the grills on the decks. And I think that's sometimes why they, call them out. So.
That's a very good point. Thank you, Tony.
I had a question about improvements and betterments. Can you speak to when it says improvements and betterments are covered with original specs? How does an insurance company use that information with maybe an association who's been around for 20 years? What should a homeowner expect with that?
Yeah, that's a really good question. And the answer is that there's not a perfect answer, especially if a home is transacted, 3-4 times and since its original construction. In that case, they're gonna, put it back to what they believe to be the original construction if they can find the plans. If not, there's a lot of give and take with original specs. I know communities where, when they were originally built, half the units chose to finish their basements and half did not. And if somebody finishes their basement after the fact and now we don't know, in that case, if there's no paper trail to say if it was original or not, it's going to get rebuilt. But I would say, at least my opinion, and Cheryl, hopefully you agree, but when we have governing documents that allow for either or, we tend to tell people it's better off to go all in because then you don't have that debate, and that kind of loophole where we don't know the answer. So.
Exactly.
All right. Can either you, Cheryl, or Tony talk about umbrella coverage? How does umbrella coverage work for an association?
Sure, I can hop in. So Cheryl talked about one of the requirements within your governing documents is that your community have general liability. General liability is what would allow the insurance company to defend you in a lawsuit. So if suit is brought because somebody was hurt or injured on the property, and your policy is going to have a liability limit. It could be $1 million, it could be $2 million. But if there was ever an event that exceeded the limits within your policy, an umbrella adds an additional amount on top of that $1 million or $2 million. So it would allow the insurance company to continue to defend you, continue to pay any judgments for a higher amount, so that any of those settlements or dollars don't come back onto the association.
All right. Are there any other questions from the group out there for Cheryl or Tony? Show screen just in case anybody's looking there.
Well, it kind of sounds like we're wrapping up. And I would just like to thank the three of you for a very informative session.
Thanks, Dick.
Absolutely.
Thank you.
Absolutely. So yeah, that will wrap us up today, and I'm very thankful for you all to attend. Watch for our next webinar coming soon, and we hope to see you there. So have a great day, everybody.
Have a great evening, folks. Thank you.
Thank you, Cheryl.